welcome everyone to another session of the Gatewood Wealth Solutions weekly market commentary broadcast. This is John Gatewood, and with me today is our Chief Investment Officer, Aaron Tuttle.
John, I'm glad to be here, and I hope all our viewers are noticing the progression that we're making on the weekly market update. We even had an intro for today.
That's fantastic. Well, you know what else we had this week? Football. And I had so many people tell me that they thought that things may be coming back to normal just because they were able to watch it on TV. It's amazing how that little thing lifted so many spirits.
Yes.
But speaking of which, the coronavirus, where are we in terms of our timeline for what we expect to happen in the market?
So, you know, John, from last week we didn't have a change. We did make some progress, so where we were starting to see that rebounding industrial activity. Once again, we're cautiously optimistic on that because there is a lot of lagging information that is coming out of the information that are feeding into this timeline. But we are happy to say we are on track based on our original timeline. We only missed a couple of things, which was opening up in early April and getting back to normal in June. That was back whenever it was 15 days to flatten the curve, and here we are in September with still a lot of the lockdowns and other restrictions. Yeah, well, certainly better than in late March. But still lingering on with those.
Yeah, I think that one of the things is that we'll eventually be updating this to see what we would forecast depending upon governmental actions going forward, but that's going to be somewhat of a moving target because we really don't have a good feel yet as to an end date, for example, as to when lockdowns are going to end, and that will impact the market one way or another.
It would. I think a lot of the hesitation and the slowness that we've seen over the last few weeks is because there really isn't any type of guide. Remember, we used to have phase 1, phase 2, phase 3 based on the 14-day average of cases. And those really were removed whenever we started to see that second wave out of the Sun Belt for the virus, and there just really isn't any indicator that's provided by government at the time. So it would be good to have some certainty on when things will start to be lifted.
But I think that'll be one thing that our listeners will look forward to is as we begin to start to think about how things will be as we get into this new phase where we don't really have the certainty of the lockdown opening or reopening. But we did have fewer cases last week. Let's talk about that.
Continue to see a decline in daily cases. There was a little bit of an uptick today in the number, actually yesterday, but we continue to be on that downward trend here in the U.S. Things are a little bit different. If we go to the United States and we look, or outside of the United States, we go to the Eurozone. The Eurozone has a much different profile. We can see that, well, it looks like our slides are not responding. Let's see if we can get that to pop up there.
So in Europe, I know that the cases are going up. Even in places like Israel, now they're going back to another lockdown because they're calling it a second wave.
Right.
What do you think about that?
Well, the European Union and Israel all had much more strict lockdown provisions, and we can see that the U.S. Initially, especially out of that Sun Belt, had far more new cases, but we have now been trending down. There are still travel restrictions based on the profile of the U.S. and the Eurozone, but we're beginning to see a lot of those new cases, what would have been called a second wave here, happen in the Eurozone as we go. So I would not be surprised to see our daily new cases dip below the daily new cases within the Eurozone.
Now, what about Sweden? Because I know that if the cases are going up, it'd be interesting to see, will their situation or circumstances be different than the rest of the European Union where they had lockdowns?
You know, I think that's a really good question and one that we want to focus on. Similar to the U.S., with a lot of criticism because of not having as strict of a lockdown and not being able to get that initial decline, where now Eurozone is increasing. Sweden was also in the news. They were to the point that they didn't have a lockdown. So it's not that they were less strict, the lockdown was not mandated. And we can see that in June, July, Sweden, which many of the articles were critical of their strategy because they were having such higher daily case counts. Well, now let's go out into September. Sweden is approaching near zero for daily cases, while Spain, France, and really the overall European Union is increasing. And I think this will help us understand what are the risks going forward to having an additional wave in the U.S., because if we don't begin to see Sweden having an uptick in their daily case following the European Union, then we have an idea that maybe that there is a herd immunity component that is much lower as a percentage than what we traditionally think of as herd immunity. A lot of that because the coronavirus could look similar to other coronaviruses. It's often a cold is a coronavirus. So we're going to be watching, as we have been this whole time, that one outlier country, Sweden. Now, if we look at death rates, Sweden is still much higher than its neighbors, which are probably the best comparison. So Denmark, Finland, Norway. Now, if you really get into the weeds, the Swedes like to vacation in the Italian Alps in February. So there's a lot of complication regarding this story. But I think if we continue to look at the data, we'll continue to see the trends, and hopefully we can see what is the risk of the U.S. Having another resurgence of the cases going into the fall. So we'll be watching Sweden to see if they have hit kind of that herd immunity where they don't see a resurgence while the rest of the European Union is getting that resurgence, which tells us that what we can't do is actually stop the spread of the virus. We can only slow the spread of the virus, and then that at least gives us some more understanding of how this virus works and the experiment that we've been doing on trying to deal with the pandemic.
Well, moving on to politics, which is where everybody's been talking about, because
Yes.
we're getting closer and closer to the special day when we're going to cast our votes. It is a special day.
It is a special day, maybe even a special week.
Right, because there might be people casting their votes periodically through the week until we get to the special day.
At least being counted. I think most of the states have put a deadline for the election day, but the processing of them could take days later.
So how does the election polling look right now?
Well, we're looking at the election odds on this slide, and the polling or the election, there really hasn't been much change from the previous week on the odds of whether it's a victory for President Trump or Senator Biden. Senator Biden still has an advantage based on the betting polls. There was some interesting news out of Pennsylvania, where there is a large surge of individuals registering to be Republican or vote Republican in the upcoming election. Now, the Democratic Party actually has some retort to that. There's liars figure and figures lie type of
Right.
component. But we think a lot of the reason that there is some increase in the registered Republican voters in this state has really got to do with the energy policy between the two candidates. If we were to look at the energy policy of candidate Biden, they're promoting more of that Green New Deal, which would significantly limit fracking. And that state, Pennsylvania, has benefited economically from fracking within this state. So they're probably losing some affiliation with Democrats. It's historically been a strong Democrat state, and Republicans are picking it up. And our guess is that a lot to do with the energy policy.
You know, it seems I've been seeing fewer ads by the Trump campaign this week.
Right. So if we have a positive that the Republicans are increasing registration in Pittsburgh, one of the negatives against the Trump campaign is they seem to be having a cash squeeze. The ads, especially in battleground states, has been going down, where they are not having as much TV ad spending. Now, the campaign says that's not a problem at all. They're just slowing down in preparation. Once again, the data is really hard to tell what is actually really happening. We're just going to have to watch over time to see what theory actually holds best. Is it that they're just strategically deploying cash and there's a little bit of a lull and they're going to be flush with cash coming into the election? or did the campaign actually overspend way too early and they won't have reserves? The Biden campaign has significant amount of capital relative to the Trump campaign at the moment.
Well, last week we talked about the red mirage.
Right.
So we had some questions on that. So maybe you can elaborate on that again.
Yeah, so one thing that we're not trying to do is take a side with politics on what party is right or not. We do try to bring an objective view on it because with politics, you always present things in a favorable way for your team. So we did try to look underneath that. But the point is that if we do have this uncertainty when we get into the November election, and it's not an election night, it's an election week or weeks, what is that going to do to portfolios? Because that's really our big concern here, is how do we help our clients become and remain financially self-reliant, or how do we protect their portfolios?
Well, let's talk about what happened when Gore and Bush had their runoff. So there was uncertainty because of the Florida election, because they had a recount.
Yes.
So how did the market do, and what was the time frame in which we had to wait to actually know the final outcome?
So one thing that with this slide is it's an oversimplification, right? We're attributing one event to a market. Markets are trying to calculate all available information out there. So this may or may not be correlated to that outcome. But we can see that after the election night all the way to Gore concedes, the market did drop about 12% because of just the uncertainty around that election. Whether all of it is attributable to the hanging chads or not is certainly debatable. More likely not all of it would be part of that. If you actually look on when Gore concedes, the market still drops a little bit further before rallying out. And this is what we're paying attention to, is just trying to understand these risks from an election standpoint, because we do think that it's very probable that we will not know who is the next president after election night.
Well, we already expect a lot of volatility just because of the amount of money that's been pumped into the system from the federal stimulus and the Federal Reserve action. So how would this play out longer term? I mean, so I know that investors sometimes are concerned about having a sudden drop because of this uncertainty in the election. We already expect all this volatility. How should they be thinking about their portfolios then in this time?
Well, I think one thing to think about, and we've talked about a lot during these market updates, is just the fiscal policy, whether that's the stimulus that Congress passed and also monetary policy being very accommodative. And if we look back historically at the fourth year for a president, which is an election year, it's either a lame duck president where that president isn't running for re-election, or an election year where the president is running for re-election. We can see when we start to separate those two, there's a significant difference. As you're going into, let's say, President Bush leaving office, that's when we get a 2008 correction. So what presidents often do, because they do appoint the Federal Reserve, is they'll put political pressure. We're not believers that the Federal Reserve is agnostic towards politics or it's not influenced by politics. We certainly believe it is, and we are not in a lame duck president, and we can see a lot of stimulus, a lot of things being done to try to make the economy strong. Now, maybe it was brought on a little early for this election, but with the amount of stimulus that has been created for this election, we actually see historically this type of election is actually decent for the market, that the returns are pretty high if that president is reelected.
So how is the economy doing since last week?
Well, we continue to see a strong growth rate whenever we're looking at the economy, but once again, the slope, or how much it's changed or grown over the last several weeks, is nowhere near where it was whenever we were coming out of the bottom of this growth, where we saw substantial increases. But we still continue to see positive news in the GDP numbers. We're still around 15.6 on growth rate. This week, what drove it up was jolts, or really the job openings for the economy.
So we had some good news on the job openings.
We did. We saw a substantial increase of, I think it was 618,000. I'm going off memory because my information is a little is not on my slide deck at the moment. So I think it was 618,000 additional openings for jobs, and that was a pretty strong number coming out of the recession. We can actually look back on this and see 2008 and see those openings trending down. Very sharp drop with this recession, and also a very quick increase. But
we still have a high unemployment.
Right.
So where's the disconnect here, do you think?
Well, I think there's a lot of factors that are in play. One, there was a very generous unemployment benefit that we've talked about many times before on possibly incentivizing people not going back to work. So that may have delayed people returning to work that would have before. We also have the uncertainty on when that lockdown will be relieved, and we certainly have gone a lot longer than was anticipated when we first hit that March lockdown. So we did see initial claims basically stay even for the week, which is troubling at this stage, as well as an increase in those that are remaining on unemployment. And what we believe is going to happen is there are a lot of businesses that are going out of business at this point, and it means that those people that were employed, especially as unemployment benefits end, will have to go find alternative work. And that means that they're going to have to be trained for different work. They're going to have to go through the application process. So this is not that situation that we were hopeful for in April, where we have a quick rebound. Most of the businesses just return, and there was just a 2 or 3 week hiccup in the model, and they all had the PPP and other loan to get them through. It's just not that stage anymore. Most people have already spent down those that loan, and they're lacking cash. Many of them don't think that things will return, especially since habits change. What is it, 21 and 90, right? 21 days to kind of get a habit, and then 90 days to make it where it's just second nature. So you were talking about watching football. Well, that may be kind of a return for normal, but if you look back at the ratings are much lower, and that's because people are no longer in the habit of watching the sports anymore.
Right. So they found alternative ways to entertain themselves,
right.
And so, you know, the question is, how will that actually come back?
What are going to be the new habits? And a lot of the businesses that did serve people's habits will change. There's been studies where people would have a restaurant that they would tend to go to, and then the restaurant closes. There may be a restaurant across the street, but that restaurant doesn't always pick up the business because people just develop a new habit instead of going to that restaurant that maybe they eat at home. It's not that they just continue. So it's really difficult to tell with the amount of change that's happened because of the lockdowns.
So we've been talking about the money supply and how we track it, and of course we had the skyrocket increase, and now it's been on the decline. We did have a little bit of a pullback last week, and now the market's up a little bit this week. Are you concerned that this drop, if it continues, is going to cause a drop in the market?
We are concerned that it will cause a drop in the market. Now, we think ultimately, if that was to happen, great catch, by the way, the Federal Reserve and Congress would be back into stimulating the economy. We don't think we're going to get a second stimulus prior to the election from Congress anymore. But as we had that rapid increase in the money supply, we became more bullish, especially with valuations lower. Now that we're seeing a drop in the money supply, we are beginning to lower our exposure to technology. We still hold an overweight. We've been adding portfolio insurance. We continue to do so this week. We hope to have qualified accounts with a 10% holding in that long-short fund, so that we still have some exposure to the market, because if people do begin to return back to economic activity and there's some certainty where businesses begin to loan, we could see that money supply begin to move up. We don't think we're going into a Great Depression at this point, but we do think that there's a lot of volatility, to the point that our next slide we're talking about 401k rollovers or cash hubs, where in March and April we had told all our lead advisors, don't have your clients do any or initiate any rollovers, because there was a strong likeliness that we'd have 5 or 6% up days. Well, we think that profile has flipped. We think that there's a strong likeliness that there will be a 5 or 6% down day. We've already seen a couple that where volatility is coming back in. We expect volatility. However, once that volatility does increase, the Fed is likely to have some type of jawboning, if not outright policy, to help support the market. So this is not a time that you want to abandon the market. We're just starting to roll into more defensive positions.
So this would be a good time if somebody has a 401k and they're thinking about rolling over. This would be the time to do it, because they're more likely to have a drop after they roll the money here than an increase.
Right, so you're not going to miss out on or you're unlikely or less likely to have a big surge in the market at this point. We don't think that we're going to see a lot of see a new high in the market until either the lockdown becomes there's some certainty about when that's ending, and or there's additional stimulus. So that's why we're beginning to rotate away from a very aggressive portfolio, starting to take some of that edge out of the portfolio.
So where are we in terms of the market and holding up the price of the S&P, for example, at this point? Because we're at highs right now. What type of support do we have for that?
So we bounced right off the trend line, so we continue to climb that wall of worry on that trend line. But we do think that we will continue to see relief rallies like we have over the last couple of days. There is a lot of cash on the sidelines that can help lift the market. It's not going to be a straight downward plunge, or at least we don't expect it in the way that it was in February, March timeframe. That it'll probably bounce off these supports. So right now that trend line did hold, and the market is rallying. We're using these rallies, so there'll be some trades and qualified accounts where we're continuing to lower our exposure to technology in exchange for the long short fund, as well as adding some commodity exposure, because it is doing well. So we don't think a downward movement is going to be there. We think there's going to be some trading ranges, and it makes sense to kind of lighten some of that beta out of the portfolio, the aggressiveness out of the portfolio.
So where are we overweight and underweight now in the portfolio?
So we continue, we were significantly overweight U.S. large cap throughout the correction and through the rally. We continue to lower our exposure to that U.S. large cap technology company, and this week we're adding it to more of that portfolio insurance. We've also pulled some of our small cap exposure, international small cap exposure, and added some commodities, and the reason being is that international small cap companies help hedge against the dollar, but so do commodities. So we thought that that was a similar kind of risk profile to be able to take advantage of commodities, and commodities are actually doing well.
So where are we with the dollar? Because I know we had the drop of the dollar, and that's another thing that we've been watching closely.
Yeah, if we look back on the trading ranges of the dollar, we continue to be in a downward trend. Relative to the last several years, the dollar is still somewhat high, and it's been bouncing off some support here. But we wouldn't be surprised to see continual declines in the dollar, which is one of the reasons that we are concerned about our U.S. Domestic exposure in one of our investment themes. We favor U.S. domestic. This seems to be an older slide because it should also say favor U.S. small cap. And the reason, and I know this slide is a little difficult to read, I'm trying to chop it up in blocks, and that first block is really when the dollar was low relative to other currencies. And we can see the blue line, well, that represents small cap companies. So when the dollar is cheap relative to other companies, it's much cheaper for other foreign companies to buy things from small cap companies. It favors smaller capitalized companies when the dollar is weaker. Now, the trade-off is a little bit of a lower standard of living because the consumer dollar can't buy imports as cheaply, but there seems to be this relationship. Weak dollar favors small cap, and then when we get into the next block, that red, we can see the dollar is trading near a kind of, let's say, a fair value relative to other currencies. It's kind of like in that middle area, and it stays in a trading range. Small cap does okay, but it's not a dramatic increase. Then we get into the end of 2019, early 2020, where there's just a lot of noise, a lot of change as the coronavirus pandemic gets worked through. But we had that surge in the dollar as there was that flight to quality, and we had a significant drop in the U.S. small cap. Now, what we're not saying in this slide is the surge in the dollar was everything as an explanation on why the small caps drop, right? All the equities were dropping, so it's a compounded effect. But then we get out where the dollar begins to trend down because of the stimulus provided by the Fed, and the dollar loses. You can see that the small cap is rallying significantly as it happens. So if we have a weak dollar, we do think the U.S. small cap is an area that would benefit from that phenomenon.
Very interesting. So how are we doing in terms of our technicals this week?
Well, as mentioned several times now, we continue to rotate away from technology, but we still are very bullish on technology over the long term. So we'll hold an overweight. We're taking some of those gains in wide moat. Some of the clients that had more than 10% of their equity position in Amazon actually saw some trades come in to try to bring them down. So the idea is that we're trimming some of that technology that has done so well and has been beaten up over the last couple of weeks because valuations were so high, and we're going other areas. And this shows if it's yellow, that means it's actually losing momentum, but it's still above the S&P 500 over the time frame that we're measuring. But look at commodities, look at international small cap company. So commodities have been really benefiting from the amount of monetary policy stimulus. We also have this flight away from urban areas to suburban areas that's really helped homes and home builders, where we see the price of lumber go up. Another thing that we've seen increase, there's a lot of famine going on in China and around the world. The U.S. is a big exporter when it comes to agriculture. A lot of grain, a lot of corn has gone up in value. Now, some people will say, yeah, but beef prices, I've seen them go down in the grocery store over the last few weeks, especially since meat processing is back in place, which is true. There's actually, as farmers who have to purchase grain to feed their cattle, it becomes a carry cost. So if you see the price of corn go up dramatically, you'll actually see an initial drop in the price of beef prices because they're sending their cattle to go be processed and get a price because it's becoming too expensive to feed them. So there's an initial drop in beef prices, and then as things come to equilibrium, beef prices begin to rise because they can only send so many cattle in. So it's kind of actually following that typical model that we see. So we've added a small position in commodities, 3%. Our benchmark is 5, so we would be a little bit underweight. But the reason that we're saying that we're overweight commodities is because we still have a strong position in the gold mining companies as well. So we're kind of lumping those together.
Yeah. So let's move into some of the questions and answers. So COVID has been referred to as a black swan, meaning that it's an unknown event that's catastrophic that we couldn't plan for. But then there are some that are now calling it a black elephant. In other words, that we've had pandemics before. We know that pandemics can happen, but we didn't really plan for it.
Well, and if you look, there's actually been several scenarios, or I guess you call them war games, where the government, World Health Organization, CDC, Dr. Fauci is on record. They have actually been playing out these scenarios for quite some time, and Dr. Fauci is on record, as well as Bill Gates, talking about a pandemic that ultimately would show up. So I think you're right. This is a black elephant. It's an elephant because it's the elephant in the room. It's obvious, but no one wants to really deal with it until it shows up. Yeah, so I like the new phrase.
Yeah. Well, I wonder though if in those war games, I know that they do play these things out. How much of that includes things like what we just went through with governmental lockdowns, right? I mean, have they actually gone through and planned out what the impact of that would be, not just the treatments or actions that they would do to try to stem the virus?
So I don't think they played it out as well. One of the problems with Black Elephant, or whatever name you want to call it, is the world and the market and just society is beyond complex, more complex than what we can work. Ultimately, that's the reason that central planning doesn't work, is because there's far more things to consider than what we could actually consider. But yes, they were playing these out. Before the lockdown was in place, and back whenever we said this would never happen in the U.S. and we were watching the things that would happen in China, it was known that the U.S. government and many of the bureaucracies were playing these scenarios, and they had already had a game plan that they would follow, which included paying mortgages and other things. So yes, they were actually playing this out back whenever the virus was assumed to be just another H1N1, SARS, swine, all the other pandemics or potential pandemics that had played out before this one became actionable, and many of those ideas were put into practice.
So let's talk about another black elephant. The amount of debt, sovereign debt. Everybody knows that we can't borrow forever. At least we would think that they know that. Maybe the modern monetary theorists believe that we can infinitely loan money, but it really is an unsustainable system, but we're not really doing anything about it.
Oh, I would agree with that. That is, it is, I guess if the mammoths were not extinct, it would be the black mammoth.
Right.
But this one certainly is not extinct. It's real. It's here. And we're quickly approaching that. We'd talked about the amount of debt or deficit spending. We've spent more, twice as much as we've brought in so far for the U.S. government this year. So there's massive amounts of deficit spending, and it's already unsustainable. It's already higher than the U.S. GDP. I know there's qualms about how to calculate that, and some people will say, no, we're approaching it. But nonetheless, we haven't seen spending like this unless we go all the way back to World War II. And people are talking about other pandemics and doing this again. We can't afford to do that type of spending, despite what modern monetary theorists say. It is unsustainable to continue to do this. And it's one of the reasons that we have been cautious on having fixed income be a significant part of clients' portfolios, because one, the interest rate is lower than inflation, and it's not, when you do the math, it's not, we're not able to pay it back. At some point, the interest rates are going to go up. There's going to be some type of catalyst that makes this unsustainable, and that means either higher taxes or there could be some type of default. That's crazy to think about, the U.S. Treasury defaulting, because they can print money. But if inflation shows up, they're going to be less able to do it. So the amount of risk that is around holding bonds in a portfolio, which is essentially loaning to other people, is at risk. It's at risk on either losing its value because of inflation or losing its value because people are not able to pay it back. And why we've been hesitant to add, despite being a little cautious and concerned in the near term about the market valuations.
So we talked about inflation being a risk, right? Mm-hmm. But there's huge deflationary forces out there. One, of course, is technology. I mean, think about it. You know, a telephone back in 1988, if you bought a cell phone, there was the size of a brick, right, with a big antenna in it, and it cost about $2,000. Well, now they cost a couple $100, and they're much more powerful today.
Well, even the latest and greatest is only about $1,500, but like you said, that's $1,500 in today's dollars versus $2,000 in the late 80s, early 90s dollars. A much different thing. And then all you could do on those bricks was make a phone call, and it'd be $1,000 a month in your phone bill, right? Because you were clicking the minutes, which were always rounded up. So yeah, definitely a different environment, and you certainly weren't
have that. So you've got the deflationary pressures of technology, right? But then you also have the debt, and ultimately paying back debt as a deflationary force,
and as well as raising taxes to pay them back.
So I'm just thinking, we're talking about inflation as being a risk, but that seems to be equally a risk. How do you balance those two? And how do you plan portfolios when you know both of those risks exist?
Well, I think one of the reasons MMT, or modern monetary theory, has been viewed favorably is because it seems that no matter how much money we create, we're not seeing a lot of inflation. I think this is where we have an old mindset on how the economy works, where deflation needs to be fought. We're going through a time similar to the Industrial Revolution and it maturing in the 1920s, where technology by its nature is deflationary. We're becoming more of a knowledge economy, and that knowledge economy is based on computer technology and the use of information, and we have transistors, Moore's law, basically doubling every 18 months. So our ability to produce is outstripping the central bank's reaction and increasing inflation. And I think this is only going to expedite it. At some point, either Moore's law slows down, where we can't cram more transistors on the chip, and all of this debt that we've created begins to surpass, because there is still constraints on what technology can do. There really are no constraints on how much money the central banks can create. So there's going to be some catalyst. Another catalyst, and I think we're seeing this now, is just the political impact, because when you do inflate the money supply, it's going to favor people with assets over people that are making income. And whether individuals actually understand or comprehend it, I do think that they, at their gut, know that there's something not working in the system whenever people continue, that 1% continue to have such massive increases in wealth. And it seems to be, and when you're doing inflation, I think that's correct, it seems to come at the expense of those at the lower income, younger people, those that most of their wealth comes from their ability to make income, and it's pushing those income. So it's either there's going to be some political fallout from that, or there's going to be some type of inflationary or debt cycle that ends. So there's pain. It doesn't seem that that's in the very near future.
But it does seem that most people don't really understand the impact that a lot of this monetary policy has that's negative. So, for example, we were talking about before how the lockdowns, even with all the money that's going in, has forced somewhere between 50 to 70 million children globally into poverty who were not in poverty 6 months ago.
Right.
And so these decisions really have mammoth consequences that I'm not sure people truly grasp. So how do we get past that, and how do we envision those things when we're talking about managing portfolios for our clients?
We don't know when we're going to hit a tipping point, right? We know that what we're doing isn't sustainable, but something that's inevitable doesn't mean that it's imminent. So it's just going to be, it's very difficult to try to time or understand when that change will happen. But the saying goes, if something can't go on forever, it won't. So at some point, there is going to be some type of reckoning, and it could be a loss in trust in all currencies, because we are using currencies to try to keep the economy propped up, because we fight deflation at all costs. We see that bad. Maybe we need to rethink that view, because there's a lot of unintended consequences whenever you start to say, well, we're going to, in the example that you gave, we want to try to eliminate as many deaths from coronavirus as possible, which is a good goal, but the economy is so complex. At what expense? What is that cost?
Right.
Because I've seen estimates where there's about 9 million that die from starvation a year. There's still people that live under $2 a day in income, and that's actually projected to double because of the lockdowns and the slowing economy. It's going to go from 9 million to 18 million. Now, we haven't seen the numbers yet. Hopefully those numbers don't prove out to be true, because these are lives. But that's why one of the things that's just so difficult is how complex of a world that we live in today.
Well, I think one thing is that we don't want to spread negativism and get people afraid. I mean, the reality is that there is wealth in the world, right? And it's just understanding, as things change, how do you organize your assets so that you're able to keep that wealth, or continue to grow your wealth. That's why we have as our mission to help clients not only become but remain financially self-reliant. And I think this is one of our themes that we're going to be talking about in the future.
And I think there is pain to come. That's certainly true, but ultimately this is a very optimistic picture, right? Technology makes our lives and our quality of life much higher. The thing that we need to do is just change our perception. But there are going to be losers in this, and you think of Kodak, right? Kodak actually came up with the digital photography, but the way that they would think about revenue in the company was film sales. And if you have digital pictures, there's no film to sell. So they never could make that bridge to figure out how to monetize that again. So I think we're in one of those paradigms where we see deflation as something that's bad because we've changed the type of economy that we're in, and it doesn't necessarily mean bad. Think of the computers and the cell phones that you've talked about. Well, these companies, whether it's Google or Apple, these are the most valuable companies in the world, yet they're the ones that are selling the products that are going down in value and have the most deflation. So I think it's just a legacy mindset that we have on the notion of inflation, and the central banks are still operating out of a model that probably doesn't actually resemble the type of economy that we're moving into. But ultimately, it's a very good thing to have technology. Our call that we're doing right here would not be possible 15 years ago for us to do. Man, what a incredible world that we live in right now. And I would bet in 10 years, whether there is this financial asset depression or not, our standard of living has still increased. We probably are no longer even having to load the dishwasher whenever we're doing dishes, right? There's some type of robot that can do that for us. So it is ultimately, I think there's a lot of optimism.
Well, I think as I get into my twilight years, I'm going to need that dishwasher because I'm not sure I'll be able to load them in there at that point.
Are you able to do that now?
I do it now, believe it or not. Well, that's the time we have for today, but I think that was a great discussion. I look forward to our future discussions, especially about the black elephant. I think that's a really good point that we're going to continue to build upon so that people can have confidence that even though we have these expectations of future calamities, that we will be ready and our clients will be ready.
Absolutely. John, if somebody has some questions after this call, how do they get a hold of us?
So what they should do is either call us directly at our phone number, which is 314-924-5100, or they can log on through the website. There's a link or an email that you can reach out, and one of our lead advisors would be happy to talk with them if they'd like to have an initial complimentary conversation. There's no obligation to talk to somebody here, but we're just here to help people, and but that would be a great way to reach out.
And those that are watching on YouTube, or will go back and watch the show, or even put some of our ideas to test. How well did we do a month or 2 months ago on what we were anticipating going forward? If you want to give us a report card, while you're there, please hit that subscribe button so that you can get the updates as these market updates are released on our YouTube channel.
Very good. Well, thanks again for your amazing commentary today, Aaron. And thank you all for listening in. We look forward to having you here again next week.